You've seen them in movies. You've heard about them in the news. Private prisons. The idea seems simple enough. The government pays a company to house inmates, a straightforward transaction, taxpayer money for bed space. That version is a dangerous oversimplification. The reality of the private prison industry is a multi-billion-dollar system built on perverse incentives, guaranteed occupancy clauses, and a business model so morally complicated that it fundamentally changes how justice works in America. Most people assume private prisons exist to save money. The logic is seductive. Private companies can run things more efficiently than the government. Lower costs, better results. That's the pitch anyway. Here's the problem. That's not how the economics actually work. In 2016, the U.S. Department of Justice released a landmark report. After years of study, they concluded that private prisons were not significantly cheaper than public ones. In some cases, they were actually more expensive. The cost savings that the entire industry was built on? Largely fictional. So if it's not about cost savings, what is the business model? The private prison industry generates approximately $5 billion in annual revenue globally. The two largest operators, CoreCivic and GEO Group, control roughly 70% of the U.S. market. Their business model is built on one thing: guaranteed volume. Here's how it works. The government signs a contract with a private prison company. That contract includes a guaranteed occupancy rate, typically 90% or higher. If the prison doesn't have enough inmates to hit that number, the government has to pay for empty beds anyway. Think about the incentive that creates. This is the most counterintuitive insight in the entire industry. The private prison operator doesn't make more money by rehabilitating inmates. They make more money by keeping beds full. Every empty bed is a direct hit to their bottom line. The economics create a fundamental misalignment. The company profits when crime rates are high. They profit when sentencing laws are strict. They profit when parole is denied. Their financial success depends on a steady supply of inmates. The system doesn't just house prisoners. It creates a financial incentive to maximize incarceration. But even guaranteed occupancy isn't the whole picture. Private prison companies have diversified their revenue streams. Immigration detention is a massive growth area worth over $3 billion annually. Companies operate detention centers for ICE, housing immigrants awaiting processing or deportation. Reentry services prepare inmates for release. These are often contracted separately, adding another layer of government funding. Inmate services like phone calls, commissary purchases, and medical care are often operated by the prisons themselves or through exclusive contracts. The average inmate spends $100 to $200 per month on phone calls alone. For a facility with 2,000 inmates, that's over $3 million per year in phone revenue. For investors, private prisons are an unusual asset class. The demand is largely inelastic. Even during economic downturns, incarceration rates remain stable. The government is legally obligated to house inmates, making the contracts highly reliable. The industry generates operating margins of 15% to 20%. Real estate investment trusts have become major players, owning the physical prison buildings while leasing them back to operators. As of 2025, CoreCivic and GEO Group shares have seen significant growth. The economics, from a purely financial perspective, are compelling, but the economics can't be separated from the ethics. In 2016, the Obama administration announced it would phase out federal private prisons. The DOJ report concluded that they didn't save money and raised serious safety concerns. Then, the Trump administration reversed that decision. Attorney General Jeff Sessions rescinded the memo, arguing that private prisons were needed to meet capacity demands. The political oscillation reveals the fragility of the industry. It exists at the whims of elected officials tied to shifting public opinion and changing administrations. One executive order can reshape the entire financial landscape. GEO Group provides a perfect case study. Founded in 1984, the company has grown to operate over 100 facilities worldwide. In 2020, their total revenue exceeded $2.4 billion. That same year, they announced the closure of 3 immigration detention centers following government contract changes. The stock price dropped 40% in the first half of the year. The company's valuation was tied directly to political outcomes and public sentiment. GEO Group's response was to pivot. They renegotiated contracts. They expanded into new markets. They lobbied for favorable legislation. The company, like the entire industry, is in a constant state of adaptation. Here's the truth that most people miss. The private prison industry isn't really about prisons. It's about a contract to manage human beings at scale. The building is just infrastructure. The real business is a guaranteed revenue stream from the government that only exists because of the justice system's failures. If we truly reduced incarceration rates, the industry would collapse. The entire business model depends on a continued supply of incarcerated people, and in a country that leads the world in incarceration with over 1.2 million people in state and federal prisons, the supply has been reliable. So next time you hear about private prisons, understand the full picture. It's not about efficiency, it's about volume. It's not about saving money. It's about maximizing revenue from a guaranteed government contract. The private prison industry is a perfect case study in how economics can can distort justice. The true cost isn't measured in dollars. It's measured in lives, in families, in communities. And those costs will never appear on a balance sheet. The system is designed to keep beds full. The question we have to ask ourselves is whether that's the system we really want.